My guest today is Nick Hatchka. Nick ran Cub Investments, more than a dozen acquisitions, mostly owner succession deals, but he's now building a regional platform of generator dealers and services in California alongside his operating partner, Dylan Ferguson. Thanks a lot for coming to the podcast, Nick.
Yeah, thanks for having me back.
Let's start with your background and life before founding Cub Investments, and then we'll talk about what you're building today. And we cover it all because there are so many lessons, and I see that you have done and achieved more than most people can ever dream of. So let's start with your background.
Sure. I grew up in the Midwest, just outside of Minneapolis, went to MIT for undergrad, and then followed the trodden path of management consulting. So I went to McKinsey as an analyst, did the analyst program there. After that, I did my first startup with a friend from MIT in the solar industry. Got a quick startup and ended up getting an early opportunity to exit. So we followed that and then worked for the acquirer and then ended up going back to business school, and then another tour back at McKinsey after business school. And then landed at a large energy company, Fortune 500. I'm doing clean tech innovation. And then kind of followed my way back into clean tech, into startups again. And then at I guess what was the last startup, that didn't end up making it, kind of came to the realization that I wanted to try something new and came across the idea of independent sponsorship or, search. And partnered up with, one of my colleagues, from the, electric vehicle startup. And, that's Anu. And we founded Cub Investments in 2016, did our first search around, in late 2016, closed on our first business in early 2017. And then we've been kind of building out that business as well as building out investing, additional platforms, additional investments. And kind of that has just, every day has just been one foot in front of the other, learning this space and getting ourselves into what we think are favorable positions to grow businesses for the long term.
So where is Cub Investments today? And from there, from where did you start looking towards like building OnPoint?
Yeah. So we started as just Anu and I with the idea that we could take an SBA loan and a little bit of personal savings and parlay that into a small business acquisition. That one led to the next, and we ended up doing, I think, 12 or so acquisitions in the interior plant space in the Bay Area. And then we started getting into exterior landscaping. And so we built up a small commercial landscaping platform kind of within that operating platform, realized that business wasn't really for us, and ended up divesting out of that one. And then along the way, as we've been kind of compounding and growing and distributing free cash flow, for the investment side, we've been making acquisitions alongside other partners, operating partners, people who are interested in what we're doing and we've struck up a relationship with and kind of wanted to go out. And so we've supported, not the search so much as the actual acquisition. So we've been equity partners in a number of acquisitions. And now, and we had a period where we were kind of looking to diversify. And so we did make a good number of, external investments in searcher-led, buyouts. And that was over the course of like 2019, 2020, 2021, even into 2022. And then when we exited landscaping, that freed me up to go and pursue a new platform. After a lot of just thinking about what we wanted to do next and our backgrounds and where we would have an advantage, we kind of honed in on the generator space and built a thesis around that. And then we raised some external capital to pursue that thesis because we felt like the capital structure, we couldn't financially support all the capital that was required to do that in the way that we felt was the best way to chase that opportunity. And so we did raise, for outside investors for the first time. And I've been running that. I guess we're almost, not quite 2 years in, but, you're about a year and a half into operating that. And I'm running that day to day, and he was still overseeing, most of the investment portfolio of Cub, the small business investments. I'm still, kind of lightly involved in, overseeing some of that as well. Anu runs day to day the office plant company. And then my day to day is mainly focused on point generators. And then we have another significant new partnership in the data center space, where we acquired a business called Wave to Wave, which is a data center cabling company. And that one's new. I'm not like super actively involved in that one, but I'd say financially fairly significantly involved in that one and helping advise the day-to-day CEO.
Looking back on Cube Investments' dozen plus deals, what patterns of success and maybe failure most shaped how you buy businesses today?
So I think when we're focused on things that we're going to be close to, like operating above all else, and probably investing in others as well, it's really just what business are we getting into? It's really business and market selection, business model selection. That's really what we focus first and foremost on. We kind of come from you want to be in what is fundamentally a good business where almost any operator has a pretty good chance of success. And while you want to diligence the operator carefully, and make sure you're selecting a good operator, I think for us, everything pretty much starts around what business do we think we want to be in, and then formulate a thesis from there and formulate a strategy from there.
Can you maybe elaborate or go more specific, like what type of businesses you prefer to invest in, buy versus ones you see immediately you will be like, okay, I'm not interested?
Sure. I mean, we definitely have some things that for us are just a straight no. Like we don't do anything in food. We will never touch anything restaurants. We don't love bricks and mortar, especially if it is very kind of if real estate constrains growth. If you do something that is real estate constraining, you at least want you want it to be able to be quite a bit bigger without having to go and acquire lots and lots of locations. At least that's how we look at it, because, we're not super experienced in real estate. We've generally tended to prefer B2B services businesses, just because that's kind of the world that Anu and I have spent, our careers in. And so I think that maybe it's just a personal preference. It's something we understand and can be more value added and helpful in. I much prefer, B2B sales than B2C sales. I'm not really a brand guy. I feel like I'm more interested in kind of technology engineering and more kind of B2B traditional B2B value propositions in the buying cycle of working with organizations. So yeah, that's, I guess, the most
now,
of it.
When it comes to using your capital, the deals you did at Cub Investments was mostly with your own capital. Am I right?
Yeah, that's right.
Okay. How did that maybe capital discipline change your deal selection and operating tempo versus now when you said you raise outside capital?
Yeah, so the outside capital is for a specific thesis. So we're not so much capital allocators in that case, where we decided, hey, we want to be in the backup generator space, specifically starting, where we are here in California. And this is the business model we're pursuing, sales, service, maintenance, rental, as well as installation, mostly B2B, a little bit of B2C. And so just given the size of that niche, the assets that are required to, really do well in that niche requires kind of a certain amount of financial wherewithal to really give that a good go. It's a more capital intensive business. There's a lot of trucks, trailers, large purchases, potential large swings in working capital. So you need to be pretty well capitalized, to chase that opportunity. And to really stand a fighting chance of success. Otherwise, you're going to be very, very constrained by your capital in growth.
Hey everyone, a quick break from the episode. I want to talk about today's sponsor, CapitalBat. So if you're looking to acquire a company or you're looking to invest in someone who's about to acquire a company, CapitalBat is a great place to look at because this is the marketplace for acquisition entrepreneurs and the investors who back them. You can list your deal, meet aligned capital, and skip the chaos because CapitalPad standardizes terms, governance, and distributions so everyone starts on the same page. So if you're, again, buying a small business or looking to invest in one, making your first or fifth or 10th investment, go check out capitalpad.com and make sure you tell them that Holdco Builders sent you. I'll also put a link in the description, capitalpad.com. And now back to the episode.
So that was the external investment strategy, and that's why we formulated kind of an external investor-led strategy for chasing that opportunity. For Cub Investments, we never really set out to be an investment company because we're pretty limited in our resources, and we're limited by the free cash flow that we've created kind of since we started because we didn't put in a huge pile of money to begin with. We've sort of lived within our own means always. So have always been capital constrained. And so we've chased things always within that constraint of like how much capital do we have right now? If we wait, what will the picture look like? And so we're kind of always forecasting and playing the hand that we have. And that very much drives what we do with the capital. Like how liquid is it? How long can we tie it up? What do we think the investment cycle is going to look like? And that, as each year has progressed, we've kind of every single year reassessed our position. What do we think we want to do this year? What does it make sense? Do we need to stay liquid because we're waiting for something? Or do we want to get money out because we think the opportunity is good and we have these 10 ideas that we think there will be plenty of opportunities that will materialize where we would want to actually make investments. So there hasn't been like a real, it's always just kind of been in the moment, decisions about what are we doing next.
Can you explain it to a 10-year-old, like what exactly does your generator business doing? Because I live in Eastern Europe. We have 4 seasons. Winters are crazy cold. So You mentioned like California, like what exactly are you doing?
Yeah. So, there's kind of 2 segments of the business. At the end of the day, if the power goes out, a lot of people need a backup. Businesses need a backup because the world needs to function when the power goes out. You can't just turn off the hospital. The firemen need to be able to do their job. The 911 center's got to work. The prisons need power because everything is operated electronically. The data center's got to stay on. So that creates a certain amount of demand for buying generators and servicing them. And servicing them is everything from before the power goes out, what preventative maintenance are you setting up? What testing are you doing? How do you know that when the power does go out, your generator is going to turn on? And so that creates business in the maintenance business where you're testing the generator, you're doing routine maintenance cycles. And depending on what you are, if you're a hospital, you're going to do that monthly. If you're, maybe a emergency responder type facility, they might do it quarterly. If you're some other facility, many facilities will do it yearly. So depending on your level of criticality, you might do more or less maintenance. So we will sell the generator, we will install the generator, and then we will do the full maintenance life cycle for those customers.
Hey, one more quick break for operators and acquirers. And today's sponsor number 2, Spacebar Studios. What they do is they turn neglected firm newsletters into deal and relationship engines. Why it matters? It's because consistent on-brand emails surface add-ons, warm broker and banker relationships, update LPs, attract founders, and support portfolio hiring without you putting too much time and effort into this because they do it all for you. Again, hands off or hands on, this is your call. Go set up a call with them, talk to them. They're professional marketers. They're very good at what they do. Many Holdco Builders listeners have been signing up with them. They run this free trial for 2 weeks where they set everything up. So there is simply nothing to lose. Go to spacebarstudios.co and book a free call with them. And I'll put the link in the description as well. And now back to the episode. And how does that criticality show up in pricing and in customer stickiness?
Well, I'd say where it shows up is in what the labor content is. It doesn't really impact our price because our price is, in some cases, if you need certain or specialized equipment to run more critical or more complex systems, that will be more costly, because if you run, a very elaborate configuration of electrical infrastructure, it takes a more well-trained individual across more areas, from like high voltage or medium voltage electricity to instrumentation and controls, things like that, versus one small generator powering, one critical circuit on a building. That's far less training required, less tools, less trucks, less equipment, less rigor, less often. So much less expensive. And then, the more upmarket you go in terms of more critical and more complex systems, more training that's required, the harder it is for that customer to find a substitute for you, which means absolutely there's going to be pricing power there, because, if you're the only shop in town, you may be the only shop in town or in the region, that can, both can do it and is physically proximate, because you do have to physically go there. And that in and of itself is limiting in terms of what your options are. You can't just call any old electrician to come and work on your system there. Most electricians wouldn't be able to do it. There's quite a bit of specialized expertise.
How was your own research process before making this first acquisition in this space? Because you could have roll up HVAC companies or roofing, but you decided generators. So what were the reasons for doing this?
Yeah, so I had been close to the business. When I was at NRG, NRG had a service line that operated in this backup power business, in the Midwest. So I'd seen the business and I'd known people from this space before. And I'd kind of been surrounded by this backup power space. So I had some familiarity coming from the energy industry, and specifically a corner of the energy industry where, we operated in this niche. And then some of this was kind of informed by macro trend. We were seeing what was going on with weather patterns, what was going on with just the aging out of infrastructure, because so much of California was built in the 60s and 70s. And so we're kind of 60 years in now. And so a lot of this critical infrastructure is end of life. And the utility business hasn't really kept up. And so what we're seeing is outages, more frequent outages, and just kind of all the major trends that you would make you want to invest in a business that solves the pain of power outage. We're all there. And so that kind of got us interested. And then we actually made an investment. We bought a minority stake in in another searcher's backup generator business, in 2020. And so we kind of got to ride along with that as well and see the business firsthand. And it's a slightly different business, different geography, but to get to ride along and see and learn, was a valuable, call it a taste test for the generator business. And we liked what we saw and felt like that kind of progressed us to the next phase where we're like, okay, we're going to go and try to find one that we can acquire and grow ourselves.
In one of your previous interviews, you brought out one of the reasons being a tiny buyer universe. How big of a difference this made? Because you've done a lot of deals, obviously a lot of competition on various companies. But this was something you brought out. Yeah,
that was definitely present in the generator industry. I think private equity has certainly caught on. And we're starting to see more and more private equity activity in our niche. And there has been for some amount of time, but especially even in the small dealer space, there are more and more firms, that have kind of caught on to this. It is a fairly small buyer universe. It's a fairly small TAM overall relative to HVAC, for instance. It's just a very small business compared to HVAC. So, or plumbing or even electrical. So yeah, we liked that it was a smaller TAM. I think the landscaping experience really helped us realize how problematic going after a large TAM full of very well capitalized, very sophisticated operators, can be. And going after kind of a smaller TAM, smaller universe, smaller company universe and smaller buyer universe kind of go hand in hand, I think. And, we felt like we would stand a better chance of competing as, a small capital constrained group like us. You need to kind of go where you can compete favorably. And that wouldn't be in, big money landscaping where everything's super capital intensive and you get really, really enormous firms, bidding up prices. And that's certainly happening in HVAC and now plumbing as well. And that, the generator business wasn't there.
You're not doing it alone, so you're doing it with Dylan Ferguson. So the importance of finding a partner. Could you tell an original story? Like, how did you find Dylan and what maybe convinced you he was the right operating partner and not just the GM?
Yeah. So after selling landscaping, kind of Anu and I, we sat down, put our heads together. What are we doing next? We, had a bunch of, thesis areas that we wanted to chase. And so we were developing deals against that. And once we started to make some progress on those, we had kind of come to I guess I was probably the primary driver that I just didn't want to do it alone. Like, Anu is going to be busy. I knew Anu was going to be too busy kind of handling other things that I was going to have to sort of activate this next platform myself. And so, but I didn't want to do it, even though I was going to have to get it going. Like, I didn't want to have to actually do the slog myself because I think, business is way more fun as a team sport. I'm not seeking drudgery in this. So I want to be able to enjoy the ride. And so, I started putting feelers out into my network and start to kind of write out some job descriptions and talk to some people in network and figure out what would be the perfect partner for a business like this. And it was sort of like somebody who's maybe a little bit younger than me, technically minded, ideally engineering, pretty, in tune with mechanical stuff, ideally construction as well. And so I kind of set out and had a straw man for what I thought would be the perfect partner. Somebody who would operate at the level of a partner. So some financial sophistication, some management sophistication, somebody really the person who I think would be the perfect CEO if I was to hire a CEO. And that wasn't the goal at the outset. It wasn't to find a CEO for generators. That was clearly going to be, I was chasing this as this was going to be, my role for this next gig, but I want to chase this with somebody who I can really just have a true partnership, and who would be in line pretty much as the obvious natural successor, should I decide to move on to the next thing at some point. I put out a call over Twitter, I think, is where I ended up starting to get a bunch of interesting responses back, and people passed it around. And I don't know, I interviewed probably 20, 30 guys, or I guess mostly guys. And Dylan just stood out as he had the perfect experience to do what we were setting out to do. And it was a good, we had a good dynamic, a good match. He had a really complementary skill set in terms of engineering, and construction. So, I felt like the division of responsibility was going to be really clear and obvious of where it would make sense for me to do something versus where it makes sense for him to do something. And so, we talked about it, met a bunch of times. He came out to visit. He was going to move. He was moving from Louisiana. So it's a pretty uprooting his family, his life, to move across the country and chase the dream. So, had to be right for him, his family, for me. We're really fortunate that it came together and has worked out wonderfully.
Did you have any test projects or trials you used before formalizing the partnership?
I mean, I guess we started kind of working on stuff together. So yeah, we did. It wasn't really positioned that way, but I basically brought him into the acquisition process. And, he was reviewing deal docs with me, and we were, looking at due diligence materials. So yeah, kind of once I realized, I thought, okay, this is the guy, then we chased the deal together, even though I was kind of the front man and the seller hadn't met him yet, but we had a chance to work on the deal together through the course of, a month or two. And then, he was privy to the investor calls. So yeah, I really brought him into the process. And, and, we could talk about the strategy and things like that. So everything actually flowed really naturally. And once we got to work together, it just became clear that it seemed like this was going to work.
And how are the decision rights split today when it comes to people, ops, M&A, capital allocation? How do you?
So we have a group of preferred investors. Anu and I are the largest from Cub. We're the two largest investors. And then we have the preferred investors, and then there's a pool for employees as well. But at the end of the day, Anu and I pretty much control the company and the board. So there's investor protections and pretty much customary stuff that you would expect in any deal where there's investor capital at play. For the most part, so there's some consent requirements and kind of bylaws and things like that. But, by and large, it's, day-to-day capital allocation is largely driven by me. And then I bring Dylan and Anu into just about everything on those decisions.
Now let's talk about the first acquisition. I think it was the Conti generator.
Yeah.
So can you talk the story? Where did you find the deal? How did it all go? And how has it been the post-acquisition so far? And maybe you can give a timeline as well.
Yeah. So, I had actually started chasing the backup generator space maybe in like 2018, initially. And then, I had my pulse on that for a number of years. And then the opportunity to acquire Conti's came up I had seen it as a listed deal on one of the deal sites at some point, and I reached out and, didn't go anywhere, couldn't even get a meeting, but kind of kept at it, trying. And it wasn't clear that there was even a deal to be had, even though it was technically listed. It was sort of one of those ones where it just everything had to be perfect. And then I think in, let's say mid 2023, I finally got a response to one of my inquiries from the seller, and it seemed like he was maybe now ready to really think more seriously about actually going through with a deal. And the broker was no longer part of it, and it was just him. And so I just went to meet him. He lived about an hour south of me. So I was actually in the area for the weekend with my family when he emailed me, and I went and met him and really got that deal activated, in terms of just I was pretty sharing everything about us. So he knows who he's dealing with, and just very transparent about, how we work and who we are and, what our intentions are. And so, yeah, and that deal ended up, we got it took a few months of back and forth and kind of getting to an agreement. And then at a certain point, once we got to the LOI, then I went and I raised the money, and then, we ended up closing. So from start to close, it was probably about 6 months, with a fundraise in between. And the fundraise was not just for that deal. We actually capitalized for the next deal as well. We raised, put enough cash to the balance sheet to complete a second acquisition. But yeah, and then, we closed that in January 2023. So January 2024. So we're, about a year and a half in, and, we've made a lot of changes. The business is probably almost unrecognizable from the business we acquired. It's quite a bit bigger, but, I think the quality is up. And we've really grown the service business a good amount. We've grown the install business quite a bit as well. And we're, really firing on all cylinders and just kind of working the P&L and trying to get better. So
trying to understand, you have so much experience with all this. You know what works, what doesn't work. You have this experience. What changes did you make? By not maybe sharing all your secrets, but you said that it's unrecognizable. What can you share? Because this is the fascinating part.
Yeah. So, I wouldn't go so far as to say we know what works and what doesn't work, because it's different in every business. I have a good feel for what to try. So it's, very much hypothesis driven about what is likely to work and what we need to do. But it's still a very iterative process, and you still make tons and tons of mistakes. And, the key is being, having this, you have to stick with it and recognize when a decision you made was wrong and needs to be reversed. With that as sort of a precursor, I think one of the things, that business was very much designed around the seller. He made almost all the key decisions. He was really the critical man in all aspects of the business. It was very much constrained, run by him and constrained by, the way he wanted things to be. And so that was a pretty big change on the day one, because the moment you take that person out, you got to figure out, how do I keep everything going in the absence of kind of that one person where literally everything, all information flows through that person, all knowledge. It's kind of that seller is the central hub of kind of everything about the way that business works. And so we really had to thoughtfully design, what can we take out? How do we solve that? And unfortunately, it's very painful, because you pretty much break everything. And you have to figure out how to fix everything as fast as you can and not fail while you're doing that. And everything from how the phone system works to, how we do invoicing to, just how the team works together, how they communicate, all of that. Everything was totally redone.
What did you see that maybe other buyers missed, and maybe what broke on day one? Because again, it was a small business, very seller dependent, but still you decided to choose it.
So we were, I think with that one, there were plenty of other buyers. And I think a lot of people were scared off by how, just the criticality of the seller. How do you even run this thing without him? And that scared us too. But at the same time, the market position that we felt we were getting into was such a good one that we would be able to figure it out. And that we would it may be painful and we were going to make mistakes that he absolutely would not have made because he built that thing for 40 years and he knew every customer and he knew where the problems were likely to arise. And of course we didn't, at least not at the beginning. And so I think other buyers were scared off by the seller dependence. It's not that we were not scared of that seller dependence. We absolutely were. But at the same time, we knew that the position we were getting into made it such that it would probably be okay. We'd be able to kind of work our way through it, as painful as it might be.
If we take this specific case, Conti generator, knowing what you know now, 18 months in, what would you maybe do differently in the first 30, 60, 90 days, knowing what you know now? If we take this case specifically, because again, all businesses are different.
Yeah, boy, I don't know that I have a good answer to that. I feel like we played it okay. Yeah, I really don't know. I feel like I think we might have grown the business a little bit too fast at the beginning. We kind of rushed out of the gate. And some of that was because the way it was being run before, we had to grow to get to a higher scale so that we could operate it without the seller, because the issue was the seller was wearing a bunch of hats that didn't really belong together in one role. And so the only way that you could actually afford to have full-time dedicated staff, he was, the primary electrician. He was the primary manager. He was the primary salesperson. He was the lead technician for service and maintenance. And we kind of needed all those positions and we needed to figure out how to fill those. And so really our only choice was you basically have to double the business to be able to afford all the full-time positions that you need to fully replace the functions that were being filled by that seller. So yeah, I guess I don't know I don't have a good answer to why, what we would actually do differently, other than maybe just work harder on recruiting and build more pipeline earlier in the process, even before close, to try to get more candidates through and really work on figuring out. But again, it's really hard to hire for a role in a fast growing, fast changing business that isn't even yours yet. So it's tricky.
What was the revenue and employee count when you bought it, and what is it now? I'm just trying to understand the growth you've been going through.
Yeah, it's running kind of about where we were last time we talked. We've mainly just been focusing on P&L and service quality. We kind of got to the scale it needed to be at. So when we started, it was around 3 million, and we're running around double that. And then team wise, yeah, it was at 7. We're around 14 full time now there. And so, yeah, and that was pretty much required to sustain the business doing everything that it was doing then, but with full-time lead electrical, lead mechanical, construction management, sales, all of that.
What were the maybe 2-3 biggest factors and drivers of that growth?
Well, putting full-time, instead of that one role being split, or, I guess those like 4 or 5 roles being shared by one person, you put people in those roles and then you systematize, build out the scheduling system so that you can manage the volume of service. The demand was there. It wasn't being met because we weren't doing enough sales calls. We weren't chasing, we weren't saying yes to enough new customers. We weren't, the throughput on our projects wasn't enough. We had enough demand. We were running like a, 9 to 12 month backlog. And so we've shrunk that backlog down. We've sped everything up. We've taken on a lot more service clients. So we had assessed that at the beginning, like during due diligence. We were pretty sure that there was a lot more demand there that was being kind of unfulfilled. Because if you're 4 weeks out to even do a sales consultation, and then when you get there, you tell them, after them waiting for you to come for 4 weeks, you tell them, well, and I'm probably not going to, even if you say yes to this, I'm not going to come, you're not going to get your generator until after next storm season. There's still enough people saying yes to keep them busy. We're like, okay, well, if we speed that up and we say, hey, you can have this thing in, 3 months, a lot more people are going to say yes. And if you get there and do a sales call this week rather than 4 weeks out, you're going to get a lot more of those appointments. So yeah, we kind of had to go on a hunch that there was market demand there, and that that business could be operated at like twice the scale, just in terms of the market demand being there.
Coming back what we discussed before, having this tiny buyer universe, now after you've been running this company for 18 months, can you maybe say more specifically, like what keeps competitors out?
So, I mean, what keeps competitors out, it's still a pretty tricky business. There's a lot of technical acumen and expertise required. So I don't think any just financial buyer can come in and succeed in this space. I feel like it needs to be a more technical buyer who has to be probably closer to the business and the industry. Industry relationships are very critical. So I think a lot of the buyers in this industry are a lot of successful buyers in this industry will be industry insiders. And so that's inherently limiting. With the Conti purchase, it was in the Monterey market. So not even, core Northern California, like Bay Area or Sacramento. So definitely a secondary market where there is limited, overall potential, addressable market in this region. So there's just not space for a lot of generator companies, to begin with. And if you're looking to grow, a generator business, that market would not be it wouldn't be on your top 5 list if you were geographically open to go anywhere in California, for instance. It probably still wouldn't even be top 5. So, the fact that we're in a smaller addressable market, at least with that business.
And when it comes to this business owner, he said he was building and running it for 40 years. Did he left right away, or he helped with customers or the business, or how did this work?
Yeah. So we arranged, we had a 1 year transition, and we sort of reduced his time over time. So he was like full time for the first couple of months. And then we reduced his hours over time until we kind of got to basically no day-to-day, contribution. He's still available by phone if we need him, but, and he's still around, but, he's still our landlord, still our lender. But yeah, and we had a plan for how through the course of those phases of kind of full-time to heavy part-time to light part-time to no part-time, what we were going to have to do to replace, those key functions. So we kind of prioritized those and worked at those one by one. And so it was clear to him, like when we brought on the key electrician, that was taking over all of his electrical responsibilities as just an example. And then sales and then kind of the last was like the kind of call it level 3 technical support, which we still use him from time to time just because he's seen everything.
What about the relationships with customers? You said that he knew all the customers, obviously doing this for 40 years. Like how do you do it in real life? Like, okay, now this guy's not with us anymore, but we are.
I mean, the thing about your generator company is you really just want your generator to work and then you want your generator company to like pick up the phone and help you if it doesn't. Well, the incidents are few and far between. You don't see your customers that often. So the service the pure relationship aspect of it, it's a very large customer base and the relationship is fairly loose. They just need to trust that you're going to be there to take care of them. And so you can finesse that and we certainly did. But really just if you keep up the service quality, you'll be fine because you can sustain answering the phone and being responsive and coming up with a plan for what you're going to do. You do need that, you have to replace that technical acumen of like, can you actually fix the problem? But as far as like the sales relationship goes, you work to keep your reputation as a high quality provider, but you do that just through the service you provide. And for us, that was building the system that could replicate the service that company was known for, in a more systematic way than it was done before.
You said you guys raised more capital than you needed for the first acquisition. So how many deals you have done so far?
So we ended up doing one more deal, so far. We closed a second acquisition, about 5 months later. 5-6 months later. It was quite a bit bigger business. And it was probably somewhat less seller dependent, not a ton less seller dependent, but certainly somewhat less seller dependent. Because it was bigger though, the seller was not wearing as many hats for the second one. The second purchase was PowerGen in Tracy, which is East Bay, so different geography, much more focused on Bay Area and Sacramento, and much more focused on commercial and industrial. The customer base, more frequent service because it's more higher criticality customers, data centers, hospitals, prisons, fire stations, police stations, things like that.
Any synergies when it comes to day to day?
Big synergies around assets, equipment, tools, technician expertise, training, upstream, like supplier relationships. Where do you get XYZ? We learned a lot from each other. We gained a lot of purchasing power, with some of our key brands and a lot of like credibility and kind of reputational, goodwill from acquiring both and then kind of starting to operate them in a more synchronized way. Of course, all the business support functions, to the extent you can synchronize them, and kind of run them consistently, tons of synergies to be had there. But yeah, I mean, we're still finding we're now over a year into that kind of post second acquisition merger integration. And really we're focused now on, while I'm still kind of paying attention to the M&A market, the PE industry has very much kind of come in and and pushed up pricing. And I think there's, some of the best assets have transacted. And there's still some opportunities out there, but I don't know if they're transactable for us, because PE seems to be throwing down larger numbers, but I mean, maybe they still will. I think our opportunity is actually just to keep pushing on service quality and reputation, and just chase organic growth for a while here.
And when it comes to raising capital, did you raise enough for the second acquisition to cover it, or you had to go out there and raise some additional funding? Yeah,
so we raised enough for our equity portion, and the seller wrote a fairly large note for that second acquisition. So we were actually able to get kind of something far better than senior debt on that second acquisition, and get into what I felt was like a comfortable debt position in terms of debt service coverage. And so we're not like overly levered, and we have pretty good terms on our debt. It's 8 years and fixed at a fairly low rate. So better than, I think, where we're not as levered as we would be if we had chased this with SBA, but we're at I think, and as far as debt service coverage goes, we're in a very comfortable position there.
And what's your overall goal with these two companies? Is it like to buy and build, to buy and sell? What's the 5-year plan?
Yeah, I mean, the plan is to just keep building. Once you're in a space and you really learn that space, there's just so many corners and crevices and ways there's so much more opportunity than you can see from the outside. And so we are still very much experimenting with different business models kind of within the overall, that leverage the assets that we have, the skills, the know-how, the people, the locations, the customer base. And so, I mean, we're still working through it, like trying out different services and different models and things like that. And so I see us just keeping at it. And the core business model of generator service and maintenance and generator sales and installations, those are there. And I think those can grow for a really long time, and we will continue to get better and better at those, and our reputation will continue to get better there. But yeah, the plan for any planning horizon that I would be, working on is to just keep going.
What are your thoughts on capital allocation inside the platform? Like, how do you decide where the next dollar goes?
So for OnPoint, we're constantly looking at this. CapEx, we're still in a very formative stage where we're like figuring out our experiments and how much our experiments going to cost versus just, more trucks, more technicians, things like that. We've really taken a lot of capital intensity out of the business, through, some leverage maneuvers. Like we did a sale leaseback on the trucks. And so now we're in a leasing arrangement for their trucks. So we can grow in a much more capital light way. We've really improved our working capital position and our contracts and terms and things like that. So we've really changed the capital, like what the capital needs of the business look like from even a year ago to make our growth more favorable, in terms of, capital allocation and what the capital intensity of growth looks like. So that really opens up a world of possibilities, because then it makes it easier to figure out, what are we going to do here? Cause we have, we could pay down pref. We could, just hold cash until we think there's an acquisition. So as of now, we're still kind of just focused on how do we generate free cash flow and what are our needs to grow and basically just focus on necessity.
You having this experience with different industries, you've seen those harder periods, harder days. What is your take on this debt and equity ratio on day-to-day basis? Like, how much risk are you willing to take, or you're more of, let's not take too much debt because tough days can come? Like, what is your take?
Yeah, I think you need to keep keep a strong cash reserve always. Make sure that you never want to go out of business. So you just have to live to fight another day always. So yeah, we're pretty conservative with cash reserves. And I'm pretty conservative with debt service coverage too. Like I like to see like a solid, like 3x coverage, free cash flow to debt service, because things happen. And this business isn't the super, it's fairly sticky, but there are some aspects that, things certainly can slow down. And so you need to be thoughtful about you don't want to go leverage too high and just assume that, the EBITDA you had last quarter is going to be there this quarter.
And Nick, you have a lot going on day-to-day basis. What do you enjoy the most, and what is maybe something you're not so excited about?
Boy, so really what I joke at the team about this. I really like building the tech, building the systems and tools that our team uses every day, and trying to make those the experience of like working inside of OnPoint, and PowerGen. I love eliminating the drudgery of operations management, of running the day-to-day business, and making things work better. And so for me, a lot of time that is just like sitting in front of my application development environment and hammering out code and working on tools and automations and sharing them with the team, getting feedback and figuring out, what are we changing next? What are we fixing next? So I really embrace just the problem solving of the day-to-day environment, finding problems that if I fix them today, they were gone forever. Like that's very energizing, for me. So.
Okay. So 2 quick fire questions. What is the best investment advice you've ever received, and what is your favorite book?
Oh boy. So one of my favorite books is Cokeland, and it's about the rise of of Coke Industries, and their strategy of always chasing kind of the adjacent, opportunity, kind of get to the edge of your competence zone, and then study the thing that is right next door, and then make your move. And that approach to expansion of like keeps you always moving forward, always progressing, pushing out the outer boundaries of your zone of competence. And you never chase too far afield of what you kind of stay close to home, but at the same time, you're always growing. And so I'll put those two together, that book and that investment advice of, staying close to your zone of competence. You don't necessarily have to read that as only do things that you know how to do, because you never grow if you only do things that you know how to do. But I kind of like the premise of figuring out what the boundaries of what are, and then kind of treading around, moving around that boundary and just always trying to make it bigger.
Nick Hatchka, thanks again. And, I really enjoyed the conversation again. Thanks a lot for doing this.
Yeah. Thank you, Mick.